Decency means more than always lower prices. Wayne Cascio, Ethics of Low Prices. The Cascio article is really a case study. It's a comparison between the practices of Walmart or Sam's Club versus those of Cascio. And so the question is, can businesses behave ethically or morally responsibly and still make a profit? And the second sort of consideration is, do businesses have a moral obligation to follow business plans that are more equitable to workers? If we discard the sort of Duska argument that the purpose of business is goods and services and embrace the idea that business is there to maximize profits, then it would seem we could be sort of agnostic between which practices maximize profit. So given two models, a Sam's Club model or a Cascio model, if both of those models are legal, if both of those models maximize profit for that business, then there might be some question, well, does morality apply to business? Now, throughout this course, we've made the argument that, in fact, morality does, that business doesn't operate according to a separate sort of moral code. And what Cascio's article does very nicely is show that, in fact, businesses can operate according to morally responsible principles and still be extremely successful. So we're looking here at the Walmart versus Cascio models and showing just how, in some ways, morally superior, if you will, the Cascio model really is. So Walmart or Sam's Club. Walmart's motto is always lower prices, or always low prices, always. Now, we should be clear is that Walmart is not a predatory organization. So in other words, when Walmart comes into a community, while it's true that it may put other small businesses out of business, so you look at your local hardware stores or your local paint stores, even grocery stores. Many times when Walmart moves into an area, those stores will eventually go out of business. They can't compete on price or selection. But once those businesses are gone, Walmart does not raise prices. In fact, it maintains its low prices. So the values of the Walmart founder is hard work, discipline, modesty, unpretentiousness, and frugality. So in many ways, Walmart still maintains those core values within its stores. It doesn't use its dominance in the market to suddenly raise prices on people once it's gotten rid of the competition. Now, while Walmart has stayed true to some of those core values, it has not always lived up to its true values. As you're probably well aware, Walmart has had problems with things like failure to pay overtime to workers. It lawsuits on gender-based discrimination. Walmart is also criticized for coming into communities and getting rid of small business. And some say that's a sort of detriment to the community. It's not just about low prices, but that you've actually broken up communities where people who once had thriving businesses no longer do so. But morally speaking, Walmart has not always been, worked at its best. But there's a bigger problem with Walmart, and this is what sort of Cascio wants to look at in his article. There's another aspect of Walmart effect that is more troubling, and it concerns how Walmart gets those low prices, low wages for its employees, unrelenting pressure on suppliers, products cheap in quality as well as price, and offshoring jobs. So if we set aside the sort of problems that Walmart might have in the community or with its workers and things like discrimination and shutting down small businesses and so forth, there seems to be a bigger problem. And due to Walmart's size, this seems to affect all of us. And that is that Walmart, generally speaking, makes its profits on keeping its employees sort of poorly paid, along with putting pressure on suppliers. In many cases, suppliers that no longer can do business because Walmart simply goes outside of the country to find lower cost, cheaper goods. So what's the Costco alternative? So as we mentioned, Walmart makes its profits by really squeezing its suppliers to give it the lowest possible prices, keeping its employees, generally speaking, paid less or worse than others. And that includes areas like benefits and so forth. So what's Costco's alternative? How does Cascio do business? How does it differ from Sam's Club / Walmart? Well, the Cascio model is different. What we should point out right from the beginning is that the Cascio has a larger market share than Sam's, although it has less stores than Sam's Club. So as far as the big box retailers go, when you compare Sam's Club and Walmart, or Sam's Club and Cascio, Cascio has less stores and yet does a greater amount of business than Sam's. They pay higher wages to their employees and have more benefits than the employees of both Sam's and Walmart's. Now, what's interesting is the Costco model has a different code of ethics. So the Sam's Club values of hard work, discipline, modesty, unpretentiousness, and frugality are different in the Costco model. The Costco code of ethics, or the Costco sort of principles, are taking care of customers and employees takes precedence over rewarding shareholders. Now, again, the Walmart model at no point says that we don't care about our customers or our employees or our shareholders. But the emphasis for Walmart seems to be on generating large amounts of profit, even if it's at the expense of its employees and to a certain degree its customers. Because again, if we look at just cheaper quality of goods, then that means what we're paying for, what we're buying might not be as good for customers as well. So at the end of the day, what Walmart seems to be focusing on is making large amounts of profits for its shareholders. So let's look at the comparison. And this is just a chart based on the amount, the numbers that were in the article by Cascio. So Costco, as you see, has about 4,000 unique items. Walmart carries about 100,000 unique items. Now, there's a comparison between Costco and Walmart because Walmart doesn't break out its Sam's Club holdings. So the question of how many products Sam's Club have is probably substantially less than 100,000. In terms of sales, Costco generates about $52.9 billion in sales. Walmart has about $315 billion. In the last year, Walmart or Sam's Club alone had about $50 billion. So even as of 2011, Costco has made $2.9 billion, roughly more than Walmart, with less stores. The average hourly wage of a Costco worker is $17 an hour. Compare that with a Walmart worker at $10.11. So a substantial difference between what the average hourly rate at a Costco is compared to an average hourly rate at a Walmart. Probably one of the most important numbers is the employee turnover. Employees that work for Costco generally stay working at Costco. So they have a 17% turnover rate at Costco. So of all employees hired, 17% of those will leave Costco. Now compare that with Walmart that has a 44% employee turnover, which, by the way, as the Cascio article notes, is pretty much an industry standard. So for most retailers, you'll get about a 44% turnover in employees. But Costco, apparently by treating its workers better, as you can see the average hourly wages, as you'll see as we get down to healthcare and so forth, employees at Costco generally don't leave Costco. Internal promotions. Costco right now has a 98% internal promotions. Means that if you start working at Costco as someone on the sales floor, there's a good chance that you can move up within that company. In fact, the current CEO of Costco started out as a store manager. Walmart, on the other hand, has about a 76% internal promotion, which means that only 76%, roughly 3/4 of their employees, still a very high number, but 3/4 of their employees will move up. But almost 1/4 of employees will be brought in from the outside when it comes to top positions within the company. Now, I think one of the most telling numbers is the stock performance. Because again, remember the emphasis on Walmart. We keep prices low, we squeeze suppliers, we keep our employees paid relatively low, again, compared to Costco. What does that do for our stock? And it turns out that Costco has shown a 55% increase in its stock, while Walmart has actually shown a decline of 10% in its stock, at least as of the writing of this article. And it seems what's interesting is this defies the sort of logic of the market. Right? The market says that shareholders are more likely to invest in a company with lower costs, which turn over more profits to investors. But Costco's own philosophy is to put shareholders last on the list, or at least third on the list of people that they're concerned about. They're concerned about employees and customers, and then they're concerned about shareholders. Another interesting number is what a CEO gets paid. So the CEO, the previous CEO who just stepped down in 2012, at the beginning of 2012, made $350,000 a year plus stock options. Now, those stock options were substantial, and as a co-founder, that would mean a lot, but it was money on paper. Right? That's not cash on hand. Compare that to the approximate $35 million that the CEO of Walmart makes, which see Walmart and Sam's Club as CEO of both of those stores. Percentage of employees with healthcare At Costco, if you're a full-time employee with Costco, you have 85% of your employees have healthcare. Walmart has less than 50% of their employees with healthcare. Add market share. Right now, Costco amounts to about 50% of the big box wholesaler type of retail. They make up 50%, where Walmart makes up 40%. Although, again, we want to note that Walmart has more Sam's Clubs than Costco has Costco stores. So Costco is actually capturing more of the market, getting more people to shop there, selling more goods than Walmart, even though it has less stores. Defying Wall Street. So as I mentioned, Costco's model, although criticized by Wall Street, again, putting the emphasis on employees and customers, and also Costco has a commitment to not charging more than 14% over cost for any of its goods. So Costco actually puts a upper limit to the profit margin that it makes on goods. What many on Wall Street, the sort of Wall Street analysts that you see on television, have criticized it for not doing enough for its shareholders. That by not cutting corners, by not increasing the amount that it charges its employees for healthcare, by not lowering wages, that they could be generating more profit for shareholders. And yet, even though the conventional wisdom tells us that we should be doing that, it turns out that the stock price of Costco consistently outperforms that of Walmart. And it seems that in this instance, shareholders are happy with the return on their investment. So whatever the common wisdom is, Costco chose to go against that, to put an emphasis on workers and consumers, again, following what we would probably call a sort of Duska model, in which the purpose of business is to provide a good and service. And the motivation may be profit, but that's secondary to what goes on. It seems that Cascio is showing us here that there is a company, a large company, that provides goods and services that in fact follows something like that model and ends up doing better in the end by doing so. So why does Costco's strategy work? Well, by and large, the reason Costco is able to continue with this business practice is its low turnover. A low turnover rate of employees means huge savings. So again, to go back to that number, Costco has a 17% employee turnover versus Walmart's 44% turnover. Now, what does that translate into real dollars? Well, it turns out that when you replace an average worker, it typically costs 1.5 to 2.5 times their annual salary. So if somebody's making $25,000, then it's going to cost you $25,000 plus another $12,500 or so, anywhere up to 2.5 times. So if you have a 17% turnover, it turns out that those turnover rates, or that amount you're paying in turnover, is fairly low. So to look here, let's assume that it only costs about 60% of an employee's salary to retrain. So if your Costco employee is a $35,360 average salary, times 60% means it's going to cost you $21,216 an employee to replace. So again, we're only talking about a 60% of what the numbers actually are. Usually it's 1.5 to 2.5 times to replace somebody, a yearly salary. But let's assume it's only 60%. Now, with a 17% turnover, that amounts to about 11,492 workers across all of the Costco stores. So you have $243 million, almost $244 million in replacements. The per employee cost of turnovers then is $3,628. Compare that, though, to the much higher 44% that Sam's has. So at 21,028 workers, at 60%, you get $12,000 per worker, almost $13,000, and that amounts to $611 million. So almost 3 times the amount is paid in worker replacement. And that costs the store $5,274 per worker in turnovers. Well, by eliminating or by paying workers a fair amount, by treating workers well, it turns out you get, as you can see from Costco's numbers, you get less turnover, which costs you less. You get happier employees. It turns out you get larger sales because it seems that happy workers also tend to be better workers at the store. So Costco sales per year are much higher than Sam's, enough to make it a leader even with less stores. So you get a more productive employee as well. And my guess would be is that productivity is not only just at work, but the fact is you get healthier employees because more of those employees have health care. And so you probably have less downtime due to people being sick or waiting until they're very sick until they go to get help. So as James Sinegal, the co-founder of Costco, says, it's just good business. I mean, obviously, anyone who is a business person thinks about the importance of people to their operation. You've got to want to get the very best people that you can, and you want to be able to keep them and provide some job security for them. That's not altruism, it's good business. So even if you're a cynic, even if you're someone who says, well, look, they're not doing this because they're good people. Now, it seems that if you read the history of Senegal, again, some of this was mentioned in the article, that he came from a sort of a mentor who really did believe in treating workers well. That part of business was building a good business, was building a good organization, was taking care of the employees that were generating the profit. But even if you are cynical of that, even if you think, well, James Senegal's made a lot of money, even as the former CEO, $350,000 plus his large, I'm sure, hundreds of millions in stock option for Cascio, it still makes good business sense. So the ethical here overlaps with the economic. It makes good business sense and it treats people well. So it seems to be a win-win situation. So as we mentioned, salaries and benefits. We have low employee turnover at Cascio. We have more efficient employees. There are 38% less employees than Sam's, even though Cascio has higher overall salaries. So 38% less workers means you have a lot more efficient workers at your Cascio store. Low rates of employee theft. Another interesting number is that Cascio has lower rates of theft within their stores. So well-paid workers, happy workers, tend not to steal from the company that they work for. And probably what's most interesting to the rest of us is the less externalizing of costs onto the community. So the externalities of a Walmart versus a Cascio makes the Cascio model even more engaging. It makes it the type of model we wish more stores would look to. And this is what we want to talk about next. What Walmart costs society. So as I mentioned, Walmart and Costco's have two completely different business strategies, two different business philosophies. And Cascio, by its business model, by providing healthcare, by paying higher wages, turns out that it doesn't externalize its costs onto the community, whereas Walmart actually does. So if we take a comparison, if you were to go to a Cascio, go to Costco's website and type up a product. So recently I typed in a product, a Nikon camera that was being offered. And it turns out that the Nikon camera on Costco's website and the Nikon camera on the Sam's Club website were actually the same price. So they were both $600 and something minus the $200 or something that was being given off. And so it turns out at the end of the day, regardless of which store you went to, you were going to pay the same price for that camera. Now, does that camera actually cost me the same amount if I go to Cascio as if I went to Sam's Club? Well, here's where there's a difference, that this business model shows that Walmart is not only making money by paying employees less, by squeezing suppliers, by outsourcing or offshoring, but it's also doing so by pushing costs onto the community, onto you and I. So, as Cascio notes, for one 200-person Walmart store, it costs federal taxpayers almost $420,750. So for every 200-person Walmart, there's a cost to you and I as a consumer in that community of $420,000. Well, where does that cost come from? Well, if you pay employees poorly and they have a low income, it means they qualify for reduced lunches. They may qualify for housing assistance. They also may get federal tax credits or deductions for low-income families. They get federal health care. So pay an employee low enough, and it means at least minimally their children will be able to get insurance through the government. And in the winter, for example, low-income energy assistance. So again, low wages for Walmart mean lower prices for you and I, but it also means that more of our tax dollars have to go to support those people who we would call the working poor. So the externalization of costs means that the camera that I would pay $600 or $475 or whatever with the rebates and so forth from these stores means that I'm actually not paying $400, but that actually I'm paying more by going to Walmart. By supporting Walmart's business practice, I end up costing myself more money, or to the tune of almost $500,000, just under $500,000, I cost the federal taxpayers that. Now that's for one 200-person Walmart store. Add up the number of Walmart stores and Sam's Clubs across the country, and that amounts to a significant amount of money. And also a large number of employees who are not doing particularly well while working full-time for a Walmart store. So it's time for you to decide, is it ethical to continue paying such low wages? So when we look at the two business models, it's clear that I don't have to pay low wages in order to make a profit, that there are alternative ways of doing business in which I can focus on service to my customers, I can focus on treating my employees well, and still make large profits. In fact, larger profits than a company that we would generally classify or sort of describe as more cutthroat. Another question is, would you be willing to pay a bit more to a company that paid better wages or benefits to employees? So while we really want to shop around, we're often looking for, and I am just as guilty as anyone else, looking for the lowest price, the best price I can get on an item. If I knew the company that I was buying from or the store that I was buying from paid better wages or benefits, would you and I be willing to pay more? It turns out that a survey said that a large majority of us would be willing to do that. Now, of course, that's easy to say until it's actually time to, put your money on the table. But it seems to me that if we calculate what it's costing us in a place like a Walmart, in other words, what percentage of those employees are getting government assistance in other areas, then it turns out that maybe paying just a little bit more at the register would save us substantially more on the other end, rather than having a large number of people living in or close to poverty, or at least being low enough or close enough to poverty to collect all these extra benefits. So is this a win-win situation? Is this win-win situation possible in all industries? Sort of the final question that you might want to consider. And one of the limitations we should point out with Cascio's article is, does this work in all industries? So it's possible that in a big box retailer, like a Sam's versus Costco, that just the nature of the business itself allows for lower profit margins with higher volume sales. It's also the case that maybe this doesn't work for all industries, that it could be possible that some industries are just that close, are just that tight, that if you were to pay more to workers, or let's say there's a limited consumer base for a particular good, that maybe this doesn't work. But it is interesting to consider whether or not we can actually radically reform our business practices to treat employees better, to not externalize costs onto society, and to still have a profitable company. So this is one of those questions: how much profit is too much profit? Is there ever a time when we can say we don't need to make that much money, we don't need to make 12 billion, we can make 11 billion, and yet be better corporate citizens, be better to our employees, be better to our consumers, and be better to the communities in which we're doing business, rather than pushing our costs or externalities onto that community? So these are things I think we really want to consider. Oftentimes there's a criticism that businesses can't be ethical, that it's too cutthroat, that margins are too slim. And so I think the Costco Sam's Club case really makes us question that assumption, that can we do good ethical business and make profit at the same time?